I usually try to be objective, nonpartisan, academic at these things, but I'm just coming off of 2 years as chief economist at House Financial Services, kind of being in the thick of it. It's going to be tough to be objective. I'll just disclose that conflict. It's sort of like trying to be objective about, one of my kids. I just think they're awesome. But let me just describe a little bit about some of the items that were developed at Financial Services over the last couple of years, and then talk about a little bit about the proposal percolating on the Senate side from Chairman Shelby. So the approach that the House Financial Services Committee took last year, after a series of almost a dozen hearings into the Federal Reserve's history and operations, had three central themes. Legislation introduced by Chairman Garrett and Congressman Huizenga, now Chairman Huizenga, did three central things, I would say. It did a lot. It's about a 50-page bill, but the three central themes there were themes that I had expected, I think we had all expected, would have some bipartisan traction. I have to say they haven't gained bipartisan traction yet in the House, but they do all come from ideas from both sort of sides of the aisle historically. The bill does three things. First, it requires the Federal Reserve to adopt a rule of its own choosing. And a rule is just an equation, just a mathematical equation to describe the course of monetary policy. And the thinking behind that approach is that picking words out of a thesaurus to describe monetary policy, which is effectively what FOMC statements do now, can never be an effective substitute for math in communicating the future course of monetary policy. That's an idea that Chair Yellen was very supportive of during the mid-'90s when she was a governor on the Federal Reserve Board. It's an approach she no longer supports now that she's Fed chairman. But that's the general sort of idea. The second general theme of that legislation was a requirement for the Fed to conduct cost-benefit analysis when it adopts regulation, a requirement by statute. They say they do it now, so the idea was just to codify what they already do. Cost-benefit analysis is an idea that has found support, on both sides of the aisle. The Clinton administration was very big on cost-benefit analysis and regulation. In the Obama administration, a law professor who had taught with President Obama at the University of Chicago, named Cass Sunstein, left his mark on the cost-benefit analysis procedures of the Obama administration. The way I would describe it is this: I think under Republican presidents, conservative economists, regulation is sort of playing an away game. I think under liberal presidents and liberal economists, regulation has a home field advantage. But I think there are still rules of the game that both sides respect. So I generally think it's been a bipartisan idea. It hasn't been a bipartisan politically in the House yet, but I hold out hope that it might still be in the future. And then the third central theme of that legislation was transparency in regulatory operations. And that's something that has also, I think, received some bipartisan skepticism. The Fed's process, the New York Fed's process of bank examination has received a lot of criticism from the left side of the aisle, from the right side of the aisle. I think the stress test process and the living will process have both been fairly opaque, as the Fed and the FDIC in terms of living wills have implemented those new tools under Dodd-Frank, and so the legislation sought some additional transparency. I hold out hope for the prospect of bipartisan interest in the bill, but if not, I also would expect that there's a high degree of probability that when the Congress comes to the debt ceiling discussion, Fed reform will be a candidate for attachment to the debt ceiling discussion. It's germane because who buys up most of the debt that got us to the next ceiling? Federal Reserve. Federal Reserve's bought up trillions in debt that's brought us to the next ceiling. So it's part and parcel of the budget and spending discussions that will take place at that time. And I think also it's politically interesting because some of the same members who would prefer never to increase the debt ceiling are the members probably most interested in Fed reform within the Republican caucus. So I think we're likely to hear it again, even if it doesn't obtain bipartisan support. So that's the House side. The Senate side has legislation that does a variety of things. One of them that was inspired by the Huizenga legislation was a requirement that each of the governors receive 4 staffers. They don't have any staff now. It's hard for a member of the Board of Governors to be an independent voice on the board when you have all your staffers provided by the chairman. And so I think that's a very interesting, very important piece of the Huizenga bill that was put into the Shelby bill. The Shelby legislation also has an idea inspired by an idea developed by the Joint Economic Committee and Chairman Brady of the JEC to have a commission to study the Fed. It's a little bit more limited than the Brady Commission. The Shelby proposal would restrict that commission to examining the structure of the Federal Reserve System. But I think that's a vitally important question for all the reasons that Dino just described. There's a debate going on about the influence of different parts of the Fed system on the FOMC, the Fed board versus the district banks. Proponents of empowering the district banks over the board on the FOMC urge that it brings more of a voice of Main Street, less of a voice of DC insiders and Wall Street insiders that you see in the Fed board and the New York Fed. And so empowering the other Fed district banks might bring more of a sort of a Main Street voice to the FOMC. I also think another important part of that consideration is just Fed independence. You'll see a theme running through all discussions of the Federal Reserve of the importance of the independence of the central bank. And I would agree entirely that that is of vital importance. We never want to threaten the central bank's independence. I don't think Congress could threaten the central bank's independence if it tried. The fact that the Fed's not on appropriations means that Congress has no tool to effectively challenge the Fed independence. That's my view. But I think the executive branch has a number of tools to threaten the Fed's independence. And if you look at the history of the Fed, from any of the major histories of the Fed, you see running through the narrative over 100 years threats to every Fed chairman from every president of the United States. Usually it runs in the influence of encouraging more accommodative policy, because accommodative policy helps incumbents, presidents win re-election. And the pressure comes from a number of ways. One of them is just closeness to the president. Most Fed board members right now served in the Clinton White House, and a number of them served in the Obama administration. A couple of them have gone back and forth. Fed staffers have gone back and forth to the Treasury Department. So there's that, and the other aspect, I think, which threatens the Fed independence is the fact that Fed governors and the Fed chairman hope for reappointment from the president. And I think human beings being human beings, there is no way for that not to threaten your independence from the executive branch. And so I think Fed independence is an important piece of this discussion, and a reconsideration of Fed structure to empower Fed district banks can actually help to protect the independence of the Federal Reserve from the executive branch. So I think it's, I haven't seen, I think the Shelby legislation has very high hopes of bipartisan appeal. I haven't seen objections to the items in the Shelby legislation on Fed reform from any of the Democrat senators yet. I haven't read them if they're there. So I think that's a very interesting piece of legislation and has a bipartisan track possibly going forward. So.